Hey everyone, and welcome to today's Explainer. Today we're going to completely demystify the inner workings of what is, quite literally, one of the most powerful financial engines on the planet. We're looking straight at State Street's second quarter earnings presentation for 2026, and let me tell you, this isn't just your standard run-of-the-mill corporate update. It's actually a really fascinating look into the financial ecosystem that quietly moves the entire global market. Okay, to really grasp the sheer scale of this machine, we absolutely have to start with this number, $57.9 trillion. That is State Street's record assets under custody and administration, right at the end of the second quarter. Just take a second and wrap your head around that. It's a staggering figure, and it instantly tells us why every single move this firm makes ends up reverberating across the entire global financial landscape.
Okay, let's dive into this. Here's our roadmap for how we're going to break down this massive corporate machine today. We'll start with Section 1, the trillion-dollar headlines. Then we'll check out 2, engines of fee growth. After that, we'll move to 3, net interest and expenses, followed by 4, rewarding the shareholders. And finally, we'll wrap the whole thing up with 5, the FY 2026 outlook.
All right, kicking things off with Section 1, the trillion-dollar headlines. Now, what's really interesting about this snapshot is that across the board, we're seeing just incredible momentum and record numbers. From that $57.9 trillion in assets we just talked about to record servicing and management fees. This visual gives us a clear map showing that State Street isn't just maintaining its massive footprint, it's actively accelerating.
Let's anchor that growth visually for a second. Total revenue didn't just inch its way up, it actually surged by 17% year over year, hitting a massive $4.0 billion for the quarter. But, the real headline grabber for investors is the bottom line. Earnings per share just rocketed up 44% to $3.65. When you see top-line revenue growth translating into that kind of explosive bottom-line profitability, well, you know for sure the underlying engines of the business are firing on absolutely all cylinders.
Which brings us to Section 2, engines of fee growth. Let's pop the hood. So, State Street is a highly balanced machine. When we look at exactly where the money comes from, servicing fees are the absolute heavyweight here, pulling in $1.468 billion. That's a 13% increase year over year. Management fees also hit a record at $772 million, and foreign exchange trading brought in an impressive $494 million. But, it's important to point out that no machine is absolutely flawless. Software services actually saw a 14% year-over-year dip, coming in at $166 million, mostly because of some elevated renewal activity they had in the prior year. But still, looking at the whole shebang, the fee ecosystem is incredibly robust. And they certainly aren't resting on their laurels either. This growth is being fueled by some very aggressive product innovation. They launched 38 new products and solutions in this quarter alone. They're pushing boundaries with a brand new tokenized fund servicing capability over in Luxembourg and expanding investor access to digital asset solutions, like a tokenized private money market fund. Plus, on the traditional asset side, their State Street SPDR Portfolio S&P 500 ETF, ticker SPYM, was selected as the exclusive default investment for the U.S. Treasury-administered Trump Accounts program. So just strictly looking at the facts here, they are securing massive mandates while simultaneously building out the next generation of financial technology. All right, let's shift gears to Section 3, net interest and expenses. Let's check the dashboard on how efficiently this machine is actually running. Here is the fundamental balancing act of banking. On one side, you have net interest income, which is basically the money they make on interest-earning assets minus what they pay out on deposits, and that rose a very healthy 18% to $860 million, driven mostly by a better funding and investment portfolio mix. On the other side of the ledger, total expenses grew by 10% to $2.65 billion. So revenue is growing faster than expenses, which is exactly what you want to see. But let's look a little closer at where that $2.65 billion is actually going. So the crucial point here is understanding that not all expenses are bad. Compensation and benefits hit $1.29 billion, which is a 9% increase, but that's largely due to performance-based incentive compensation. Basically, when the firm wins, the team gets paid. Information system spending jumped 17% to $589 million, pointing straight to strategic tech modernization and system resiliency. But here's the really wild efficiency metric. Despite all these investments, overall headcount is actually down 3% year over year. They are completely optimizing their workforce while still heavily investing in the tech that powers them. Moving right along to Section 4, rewarding the shareholders. If you're an investor, this is the number that matters to you right now. $631 million. That is the massive total amount of capital State Street returned to its common shareholders in just this single quarter alone. Breaking that $631 million down, it consists of $231 million in declared common dividends and a hefty $400 million in common share repurchases. So they're essentially buying back their own stock while also paying out cash. But here is the thing, they're doing all of this without risking the foundation of the bank. They maintained a really solid standardized CET1 capital ratio of 10.8%, and that's a core measure of a bank's financial strength. This metric essentially proves they have the financial stability to aggressively reward their shareholders while maintaining a highly secure capital buffer against any unforeseen market shocks. Finally, let's look out the windshield at Section 5, the FY 2026 Outlook.
And this brilliantly illustrates the sheer momentum the firm is carrying right now. It's undeniable. Look at how they've actually had to upgrade their own projections. Their prior outlook for fee revenue was 7 to 9% growth, while they've bumped that up to an aggressive 12 to 13%. Net interest income expectations, those jumped from 8 to 10% all the way up to 14 to 15%. Now, to fuel that kind of accelerated growth, they did have to revise expense growth up just a little bit, moving from 5 to 6% up to about 8%. But the net result is a significantly more powerful growth trajectory for the rest of the year than they initially anticipated.
Let's move on and see how this all builds into their overarching vision. They call it the One State Street strategy. It's essentially their master plan to integrate their massive global scale into a single unified platform. They are systematically connecting asset managers, asset owners, and wealth management so that a client can seamlessly access front-to-back servicing, liquidity, and data insights all in one place. By unifying their coverage and integrating all that data, they are creating a sticky ecosystem that makes it incredibly difficult for clients to ever leave once they're fully plugged in. Which really leaves us with this final thought. We've seen the staggering $57.9 trillion scale, the record revenues, and this ambitious One State Street strategy. But as we all know, macroeconomic conditions are always shifting, right? So the big question is, will this highly integrated, deeply embedded global model be resilient enough to actually sustain these record-breaking numbers when the unpredictable global market inevitably shifts again? It's a fascinating question, and one we will for sure be watching very closely. Thank you so much for joining me for this explainer, and keep learning.